Create that financial discipline in you. Do not spend beyond your means of income. That's a starting point.
Hello and welcome to the show called Invest Qatar, where we dwell into the world of businesses, investments and finance. Well, today in this episode, we'll be talking about debit and credit cards and of course about bank loans. To share the complete story, we have with us our guest, Mr. Sree, Head of Terminal Control, Qatar Energy LNG. Let's welcome him on FM 107.
Thank you very much, Nazia. Good evening and thank you for having me in your show.
Pleasure to have you. Since today's topic is all about debit and credit, so we would love to start with this. What are the primary difference between debit and credit cards?
Right. So as the name suggests, the credit card, it's a line of credit. Credit is extended to a borrower by a lender. So that's about the credit card. So if you look at the debit card is nothing but it's an instrument that is helping you to kind of manage your own finance that is there in your bank account. So it helps you to withdraw cash, it helps you to transact with the businesses or for your shopping, your travel and so on and so forth. So that's the debit card of it. But both the cards in principle will help you to do all these financial transactions, but one is the loan and the other one is your own money you're managing. So debit card helps you to manage your own money. Credit card is a kind of a loan that is extended by the lender, which is in principle is bank.
Also tell me, what are the benefits of using credit cards over the debit cards and of course the vice versa?
The debit card is one thing that is, as I said, is your own money you manage. Okay, so long as you have so much of money in your bank account, you just use that for the withdrawals as well as for your shopping or whatever transactions. But then beyond, once that money is exhausted in your bank account, you won't be able to spend anything more. So that is where the kind of limitation of a debit card is. Whereas the credit card, on the other hand, is money that has been extended to you as a line of credit. So what helps you to kind of those who do not have money, you can borrow money. Of course, that comes with certain interest rates and so on and so forth. So interest, again, if I may have to explain that, some may call it as commission, some may call it as arrangement fees, some may call it as profit. And in general, it's all about cost of finance. So you take certain amount from someone else and that will cost you money. So that cost of money is, again, is a package where the initial borrowing or initial arrangement fee plus the interest that you will be paying. So that's the cost of finance. So in general, credit card will help you to manage your financial transactions on a loaned funds with interest, and then make sure that you always kind of pay that back on time. Now, again, going further down, credit card always, or the lenders will lend you money only based on your credit score. So credit score is attached to your credit card. So if you default any of your repayments, obviously your credit score will go down. And then that also kind of reduces your ability to get more and more funds as you may require by way of a loan. Whereas debit card, you don't have such credit rating or credit kind of points for you. And also further, the credit card will help you to accumulate certain points. It could be by way of shopping points, it could be travel points or travel miles, or it could be some banks are offering cash back up to 5%. They will say, you spend this much, we'll give you, refund this much money to you. And sometimes you also carry these points for your access to the hotels, airport lounges and so on and so forth. Debit cards may not have these features. So that's a difference between these two.
Very well said. Okay, now for example, I'm planning to buy a new laptop and I have this option of credit card as well as the debit card. With which option should I go?
That's an interesting question. So it all depends, right? So basically it starts with the financial background of yours.
Okay.
For example, if you have some money, would you really want to go for a loan or not is a question. Again, it's a question to be asked by you. What do I need to do with that money? Either should I buy that laptop or should I take a loan, which is via the credit card, and then get that laptop for me for a small kind of cost of finance. In other words, it's called interest. And then whatever savings that you had, you can invest elsewhere and generate some additional interest from that deposit or somewhere investment, and see what's the differential, what you learn as an interest, and what you will pay as an interest in the credit card. So that is the way that you would look at, and then you balance it out and see how you wanted to play with this. Now, one word of caution is that at least the younger generation, what I've seen nowadays, they always leverage on this facility, credit card facility. They spend beyond their means of inflow. When I say inflow, is your income, your revenue, whatever. And then they end up, with the defaults. And then once you are defaulted your credit card repayment, your credit rating goes down and you won't be able to generate further kind of loan funds. So that is one aspect. And then going beyond is that once your credit rating goes down, obviously your interest costs will also go up. Next time you go for loans, you'll have to pay higher interest rates. So those are the things that you would weigh against and see if you have cash, if you don't have cash. That's a starting point. So, and if you have cash, then you say, where do I deposit and where do I generate some income for myself? Or if you say that I do have both, then you basically leverage on and then hedge on the interest, what you earn versus interest what you pay, and see where you stand. And then you make a decision and then go forward with that.
Okay, now tell me, Mr. Sree, what are some of the common credit card frauds and what are the steps that one should take in order to prevent oneself?
Debit cards usually, I would say, is less protected compared to the credit cards. As you know, credit cards mainly are issued by two principal agencies called MasterCard and Visa. So they have multiple protections against all these online frauds. Now also dual authentication and further that with the SMSs that will alert you. But then you get all of a sudden a call from someone representing as if he's a banker, and then he wants to part with your credit card number and the CVV number, which is a 3-digit number at the back of the card, and so on and so forth. So my request to everyone is never part with your the credit card number nor the 3-digit number at the back of your credit card. And also sometimes you will see websites asking for your credit card to be stored in their website. So there is a possibility that first time transaction goes through, and then later on what happens, without your knowledge, they will start to scheme. It's called skimming. So they start to take $1, $1.50, $2. You wouldn't even notice that. So I would advise every user of credit card to look at your credit card statement very closely on a monthly basis if you can, and check out your transactions, because that's the only way you can find out. And then there are certain SMSs that comes as if it is a bank SMS, but there is always an embedded link the moment you click it. Because as recently as one of my friends had an SMS coming through, and then he clicked on that, it was represented as if it is from Ministry of Interior for a traffic violation, and he ended up losing about 6,000 riyals. So don't even click on any of these SMSs. Even if you're late, no problem. Pick up the phone, talk to your banker, identify, and then talk to your customer relations manager. Find out whether it is really from the bank. That particular message by way of a mail, by way of an SMS, or any other means. Even if it is a telephone call, never attend any of these calls. So that's my simple advice to all the listeners.
What are the advantages of securing a loan from a bank as compared to alternative financing options?
So bank loan versus alternative finance. So let's look at that. There is in the world, all of us are actually lenders and borrowers, you and me included.
Yes.
For example, I save some money, I deposit in the bank. So basically I'm giving my money to the banker. Banker gives me a little bit of interest, but he uses that money to lend to someone else who is in need of money. So in general, all of us are, in a way, are lenders as well as the borrowers. Right. So that's the background. So then it all depends on, what are the needs, and then why do you need these money? That's one's kind of it could be for my personal purposes, it could be my commercial purposes, it could be for my vehicle, it could be my house purchase, or my business requirements, right? So these are the kind of requirements that basically drives the need for money.
True.
How do you get it? It's again, there are multiple lending agencies. I would say in principle, the principal agency is the bankers, and then followed by that there are multiple layers of lending agents. The next one is the non-banking finance corporations. I mean, in India, that there are multiple non-banking financial corporations. And then of course there is a unorganized sector where you have personal money lenders to cooperative unions, and then there are peer-to-peer financing and so on and so forth. So there are multiple layers of lenders. Now, why do I approach to these multiple different lenders? Again, based on my need, again goes back to our initial discussion, is about my credit rating. Is I'm a person who is with a high credit rating, I can always approach my banker, because banker knows that I do have a steady income, or I do have a revenue income. It could be from my business, it could be my professional practice, it could be from my employment. I will be able to repay that. That's a confidence that they have with the credit rating. Now, if you don't have that much of credit rating, what do? Still you need, you're in need of money. What do? You go to a second layer, to the third layer, to the fourth layer of money lenders. So you go to non-banking finance corporations. So that's where probably, not as rigid as what you see a credit rating, formal agencies or the ratings are evaluated. However, there are kind of alternate mechanisms to kind of evaluate your credit rating, even by NBFCs. Rules are not that rigid. You can always get some money. But the moment you talk about, credit rating is lowered, the rules are not that rigid. Obviously, you talk about the cost of finance, the interest is going up. So that's the difference. And then you go further down to the layer. Obviously, it's all, there are multiple, again, you talk about peer-to-peer financing. So that's another area where platforms are provided by multiple agencies. They say, okay, there are lenders. I have some surplus money. I want to lend it to somebody. How do I lend it? I don't know who's going to be the borrower, right? So these platforms will facilitate who's in need of money. They also come to the platform. They say, yeah, I'm in need of this much money. So like me, I say, okay, my cost of finance is about 15%, 20%. I mean, as you go down the line, where no credit rating, no credit standing, you need money, yes, then you need to pay extra as an interest, right? So that is the background with which, borrowers approach these platforms, and then the lenders will kind of lend you that money. Now, for the lenders, it's the highest risk that they're undertaking. Because when I know that you have a very high credit rating, I know for sure, say 95%, 99% confidence, you will be repaying that money with interest to me. I'm the lender.
Yeah.
But if I'm the participant in that lending platform, which I talked about, peer-to-peer or cooperative unions and so on and so forth, there are different criteria, right? So there I take the highest of risk as a lender. Of course, you also have the kind of advantages of getting a little bit of money, but very high interest that will be paying. The cost of finance is very high. But then the risk is that I could lose the entire money, because you could be at default. So that's the kind of, as you go down the layer of lending, that's the kind of risks for the lenders. And then of course, risks for the customers as well, because they pay highest of interest rates. I mean, as high as 30%. Can you imagine? Yes.
How would you like to conclude this topic?
Create that financial discipline in you. Again, as the saying goes, charity begins at home. So for your kids and younger generation, my simple advice is that do not spend beyond your means of income. That's a starting point. Of course, even including myself, I've gone through this in my lives. Definitely, I was in need of a little bit of money. So obviously, you take that, but make sure that you repay. Don't get into the debt trap. Debt trap is that you reduce your credit score, and then so don't live on credit funds only, or do not live on loan funds. So always make sure that you repay that, have that financial discipline, and it's called the financial integrity. And then, so maintain that, discipline in your life. You will see that it's stable. And then even with the loan funds, again, as I say this, you can always create assets. Try to create assets. Once you have a house in your name, which is completely debt-free, you can mortgage that to get more funds, but don't live on that funds, or don't spend that just for fashion, just for buying automobiles or whatever. No. Make sure that you have solid assets first, and then you start to see how you can leverage on that assets.
Very well said. Beautiful advice. Thank you so much for taking out this time and sharing useful, very, very useful information with us.
Thank you
so much once
Thank
again.
you.